So our last meeting saw us looking at the framework of what we call groups. We saw what IFRS 10 said about what gives one company control over another and what itself is control. Once one company has control over another, please go through those lessons again. Then there is a requirement that the guy who has got control, the company who has got control, should bring together its financial statements and those of the one over whom control is got. In your FR exam, you might be given the statement of profit or loss of the parent company and that of the subsidiary. Maybe also they'll add the other comprehensive income where we got revaluation, surplus, and all of those. Your job will be to bring these together. This is covered in chapter 24 of the Study Hub. This morning, I'm going to walk you through what is in there, bit by bit. We might not finish this morning, but largely we'll grab all the principles as much as we can, so we can extend that, we can apply that knowledge to bigger questions. When we are done, then we ask ourselves, what if in the exam, it's not a statement of profit or loss of parent and subsidiary that we are asked to bring together, but rather the statement of financial position. And that will take us back to look at chapters 22. In fact, chapter 22, but a big part of chapter 22 will be that we have to do something on goodwill, which is in chapter 23. So this is the journey. Let's dive into chapter 24. I have a diagram which I copied from Kaplan. What this mind map is telling you is that if you are asked to bring the statement of profit or loss of parent and subsidiary together, so we call it group statement of profit or loss, or if you like, consolidated statement of profit or loss, the recommendation is that you should put up the pro forma. The pro forma means just copy out the examiner's lines. And there are some things which are introduced into those lines, very few. So copy the lines, and then there are problems you will meet. One of such problems is what we call intra-group transactions. Let me tell you about intra-group transactions. Parent and subsidiary form a family. We call that family a group. From an accounting point of view, although the law says they are one, from an accounting point of view, although the law, I apologize for that, sees them as separate entities, accounting sees them as one. Now, if you are one, then it will be insane to hear that I have made a sale to myself. And that's how it's going to sound like if you said the parent company made a sale to the subsidiary company, or the other way around, subsidiary company made a sale to the parent. It will be like you talking to somebody and said to the person, I sold my car to myself, which doesn't make sense. From an individual company point of view, it makes a lot of sense that there is a seller and there is a buyer. It doesn't matter, there's a relationship between them. But from an accounting point of view, it sounds insane. So if there's any such thing, we acknowledge the fact that one man's meat is another man's poison. What do I mean? The party selling to the other party, the seller gets revenue, but for the buyer, it's cost. So that sale between them is called an intra-group, if you like, intercompany sale. And the rules of consolidation require that we eliminate them. I'll get down there, and when we see examples of intra-group trading, I'll show you how we eliminate intra-group sales. 2, once the party who has received the goods has not ended up selling all of those goods by year end, whatever profit has been made by the seller, we must remove it from the group accounts. And I'm going to tell you more about it. We call it provision for unrealized profit adjustments. In a mind map, you see PUP. We're going to talk about PUP. 3, we saw what IFRS 3 says when we were doing the conceptual principles of groups. IFRS 3, business combinations, requires that when the two parties come together from an accounting point of view as one, the assets and liabilities of the subsidiary have to be added to those of the parent. But in doing so, those assets and liabilities must be added at fair value. For now, just take fair value to be the market price or something. But then there are some rules about what it truly is. The details we'll look at later. But whilst you are bringing the assets and liabilities at fair value, it will also end up resulting in something we call fair value depreciation. So this is the point. The land land is not depreciated, so forget about land. The buildings or the computers or the other equipment of the subsidiary, which in their books, they bought it some time ago for $5,000. They have depreciated it by $2,000 by this far. So on the date of acquisition, which IFRS 3 is concerned about, what happens? 5,000 minus 2,000, the carrying value of the assets is 3,000. IFRS 3 says, don't bring those assets into the group at that amount. You should bring it at fair value. Fair value means that asset we are talking about of the subsidiary. Today, if we offered it for sale, how much shall we get from the sale? Rather than how much we bought it for many years ago minus how much we depreciated. How much shall we get it for it? So imagine we shall get it for 4,500 if you offered it for sale today. Then the carrying value of 3,000, that's 5 minus 2, 3,000, has to be adjusted upwards to 4,500 because the requirement of IFRS 3 is that the subsidiary's net assets must be brought into the group at fair value. So if it was 3,000 book value, but you bring it at 4,500, then it means that there is a plus 1,005 you have done. That plus 1,005, an increase in value of an asset, will result in extra depreciation. We call that extra depreciation fair value depreciation. Next, IFRS 3 requires goodwill to be calculated. We'll look at the details later. But when that goodwill is calculated, just as an asset is depreciated, that goodwill is subjected to what we call impairment. Impairment, take it for now to their fall in value. We would look into the details. That impairment is an expense. So we introduce the expense into the accounts, the group accounts. So impairment. Then next, so long as the parent did not acquire 100%, and you remember you don't have to acquire 100% to have control, did not acquire 100% of the subsidiary shares, some other guys have control over, and I'm using the word control carefully. Let me don't use the word control. They don't have control. Some other guys have ownership of the remainder of the shares of the subsidiary. So, for example, if the parent has acquired 85% of the shares of the subsidiary, then the remaining 15% of those shares were acquired by other people. We call these other people non-controlling interest. When you are copying your pro forma, so long as there is a non-controlling interest, which means the parent did not buy 100% of the shares, then we introduce a line somewhere to represent the interest in the profit of the group that these 15% shareholders in the subsidiary have. So Kaplan's mind map, which is in my class notes for you, is saying to you that if you go into the exam and you are given profit and loss statement of parent, subsidiary, and you have to bring them together, the principle of group accounting is just add the lines for incomes and expenses. But your job is put up a pro forma. 2, these are the problems FR exam questions will talk to you about. We're going to learn how to go through or deal with these problems. My hope is that by the time we are done, then there is no way you should be scoring less than half. That's less than 50% of the marks available when you are asked to prepare group accounts, group statement of profit or loss. I'm going to start with a very baby example, something that is not the kind you will get in the exam, but it will have the principles that you will learn. You have to learn and apply to bigger questions in the exam. Any questions or requests for clarity on anything? Keep this mind map in your in your mind, and be prepared to deal with the problems around the map. Intra-group transactions, provision for unrealized profit adjustments, fair value depreciation, impairment, NCI, we call it simply non-controlling interest. So that if there is no such, let me consider this as an introduction or a background to the group statement of profit or loss, and let's start slowly by looking at questions from what I consider to be the simplest form to the most difficult form.